In a twist that's left investors buzzing, gold prices have taken a step back after an unprecedented surge, with all eyes now fixed on the upcoming U.S. payrolls report for fresh insights into the Federal Reserve's next moves. This pivotal moment in the financial world is shaping up to be one of those instances where fortunes can shift overnight, especially as traders brace themselves for what could either confirm or challenge their expectations. By mid-morning on Thursday, spot gold had dipped by 0.4%, trading at $3,544.15 per ounce. Meanwhile, U.S. gold futures saw an even sharper decline of 0.9%, settling at $3,603.70. What's driving this pullback? It's largely attributed to profit-taking following gold's astonishing ascent to a record high of $3,578.50 just the day before. That peak was fueled by soft labor market data, which reinforced bets on interest rate cuts and stoked demand for safe haven assets amid lingering economic uncertainties. But here's where it gets intriguing. The spotlight will soon shift to Friday's non-farm payrolls report, a release that could redefine how markets perceive the Fed's monetary policy trajectory. Earlier in the week, jobless claims rose more than anticipated, signaling some easing in the labor market. Yet, opinions remain divided about whether these numbers are enough to sway the Fed's stance significantly. With rate cut expectations already baked into current pricing, tomorrow's jobs data takes center stage, explains David Megger, Director of Metals Trading at High Ridge Futures. Any deviation from forecasts would ripple through currency markets, impacting the dollar, and consequently, gold. And this is the part most people miss. Even small fluctuations in employment figures can trigger outsized reactions in precious metal markets due to their sensitivity to macroeconomic shifts. Adding fuel to the fire, several Fed officials voiced concerns earlier this week about weakening labor conditions, reinforcing speculation that further rate reductions might still be on the table. According to CME Group's FedWatch tool, there's now a staggering 98% probability priced in for a 25 basis point cut later this month. For context, lower interest rates tend to boost gold's appeal since it doesn't offer yields like bonds or stocks do. In times of uncertainty, investors flock to gold as a store of value. And let's not forget the geopolitical drama unfolding behind the scenes. U.S. President Donald Trump recently escalated tensions by attempting to remove Federal Reserve Governor Lisa Cook, a decision mired in controversy and sparking debates over central bank independence. This development has added another layer of complexity to the global financial landscape, keeping safe haven demand for gold robust. Meanwhile, halfway across the globe, Poland's central bank governor, Adam Glapiński, announced plans to increase the country's gold reserves target from 20% to 30%. Such bold moves underscore the enduring allure of gold as a reliable asset in uncertain times. But does this signal a broader trend among nations seeking to diversify away from traditional reserve currencies? Or is it merely an isolated strategy tailored to Poland's unique needs? Elsewhere in the commodities space, silver also slid by 1.2% to $40.71 per ounce after reaching its highest level since September 2011. Platinum plummeted by 3.8% to $1,367.61, while palladium shed 1.6% to settle at $1,129.86. These declines reflect the broader risk-off sentiment gripping the market as participants await clarity from the upcoming jobs report. So, what lies ahead? Will the payrolls data justify the recent optimism surrounding potential rate cuts? Or will it expose cracks in the foundation of bullish gold sentiment? One thing is certain, volatility is inevitable, and seasoned traders know better than to underestimate the power of such reports. We'd love to hear your thoughts. Do you think gold's rally has legs, or is it time to cash out? Share your predictions in the comments below.